You're listening to the Financial Source podcast on YouTube.
Welcome back to the Financial Source podcast.
It feels like markets are starting the week in a really cautious mode.
Definitely caught between all these escalating geopolitical developments on one hand.
And on the other, just a heavy macro data calendar, with some of those U.S. releases still delayed.
Right, and we're seeing that play out in the U.S. dollar. It's firming up as money markets start to reassess the Federal Reserve's path.
They're really reassessing it. The implied odds for a December rate cut have slipped all the way down to around 40%.
Which is a huge shift. Meanwhile, commodities are all over the place.
Oh, completely reactive. You've got oil benchmarks rebounding sharply after the latest headlines from the Middle East, and then there's still that vulnerability in the Black Sea flows around Russia's Novorossiysk port.
So today, we're going to unpack how this cautious sentiment is hitting major currencies like the euro and the yen, especially after their recent data.
And we'll also track this complex evolution of global trade friction. I mean, from rare earths deals all the way to these new corporate supply chain mandates.
And finally, we'll listen to what central bank speakers are signaling globally.
Let's get into it.
Okay, so that's strength in the U.S. dollar. That really feels like the headline story here.
It is, and it all centers on this sudden lack of conviction around the Federal Reserve's path.
I saw the numbers. The implied odds for a December rate cut slid from, roughly 50% down to 40?
Down to 40, and that 10-point swing is massive. It explains the mild but pretty persistent bid we're seeing for the dollar.
What's fascinating to me is just how sensitive the market is to these tiny adjustments in future policy.
It's extreme sensitivity. We are absolutely starting the week in full show-me mode from the Federal Reserve.
And we're about to get a lot of that show-me data. We're expecting the delayed U.S. non-farm payrolls.
The Federal Open Market Committee minutes.
And a whole parade of Federal Reserve speakers. I think I saw Williams, Jefferson, Kashkari, and Waller all speaking just today.
Exactly. And the market is looking for some kind of affirmation from them.
Right. Are they sticking to this tighter for longer script, or have they seen something that makes them rethink the whole path?
And until we get those definitive inputs, the dollar just maintains its firm stance. It's basically acting as the anchor for global risk pricing right now.
So if the dollar is the anchor, what's happening to the rest of the currency fleet? Let's start with the euro, which is trading around the 1.16 area.
Well, the euro is softer, but the tone from the euro area is one of, let's call it, highly cautious confidence. And that's a key distinction.
Cautious confidence, okay.
Yeah, we heard European Central Bank official de Guindos sound a bit more optimistic on growth, suggesting inflation is converging toward target. But, and this is the crucial part, that confidence isn't clean. It's immediately qualified by some really serious concerns.
How can they feel good about growth but bad about stability at the same time? I mean, if the European Central Bank sees better growth, why are they flagging these major financial stability risks?
Because it's the crucial structural issue the market is trying to ignore. De Guindos, he flagged the risks of, abrupt market corrections, significant fiscal vulnerabilities across the region, so think high sovereign debt loads, and potential trouble in bank credit quality as rates stay high.
So it's a very narrow needle they're trying to thread.
A very narrow needle. They're trying to celebrate disinflation while being hyper alert to the systemic risks that high rates bring into the system.
That structural tension is a critical takeaway. Okay, let's pivot to the Japanese yen. It's modestly weaker, even though Japan just reported its first GDP contraction in 6 quarters. That seems completely backward.
It does on the surface, but this is the ultimate policy divergence story.
How so?
Well, the contraction was actually shallower than everyone feared. It mainly reflected weak exports and softer tourism. Most analysts think this dip is just temporary.
So what's really driving the currency weakness then?
It's the sheer commitment to massive fiscal stimulus. That completely outweighs the negative GDP print.
And when you say massive, we're talking about a level that must feel like, printing presses go brr territory, right?
It's a phenomenal scale. Reports suggest a package potentially around 17 trillion yen. We've even got government advisors like Kataoka pushing for up to 23 trillion.
And that's funded by new bond issuance, which is currency weakening.
Exactly. And you couple that fiscal push with extreme caution on monetary policy. Kataoka specifically argued that any rate hikes should wait until March or April of 2026.
2 years from now.
Right. So it reinforces the narrative.
Yeah.
The Bank of Japan is in no rush to normalize. that just keeps the selling pressure on the yen.
That brings us to Prime Minister Takaichi meeting with Bank of Japan Governor Ueda this week. The markets will be watching that one intensely.
Absolutely. Even sterling is kind of holding its breath. It's flat to slightly lower as traders focus on the upcoming United Kingdom budget.
Which shows how governments are now forced to get creative to raise revenue.
So creative. There are reports the UK government is looking at like a nightly levy on hotels and short-stay rentals for tourists. Just searching for ways to raise revenue without touching the headline income tax rates.
Okay, let's shift focus to global trade, because the friction there feels deeply intertwined with all of this.
It is. And we're seeing some mixed signals, specifically between the U.S. and China, on critical materials like rare earths.
Right. I saw that U.S. Treasury Secretary Bessent expressed confidence a deal could be completed by Thanksgiving. That sounds positive.
It sounds positive, but the crucial insight is what he said next. He immediately tempered that optimism by stressing that Washington has many levers if China fails to comply.
So it's a conditional détente, a diplomatic success that's basically contingent on a threat.
Precisely. And that underscores just how fluid global trade policy is. You also had U.S. President Trump suggesting further tariff rollbacks won't be necessary, even as talks continue on things like soybeans.
And that ties trade policy directly back into domestic politics.
It does. I mean, President Trump's proposal to send $2,000 dividend payments from tariff revenues to U.S. citizens, well, that needs congressional approval. It shows how tariff policy has become this highly visible, politicized domestic tool.
Beyond the rhetoric, though,
Yeah.
how are these tensions reshaping actual supply chains on the ground?
I think the best example is the mandate coming out of Tesla.
What are they doing?
They're reportedly requiring suppliers to exclude China-made components from vehicles made in the United States. And this isn't a government regulation.
Right, it's an industrial policy decision being dictated by a massive corporation.
Exactly. They're preemptively de-risking their manufacturing base. It's corporate strategy actively dictating the evolution of global trade.
And this friction isn't just a U.S.-China story.
Not at all. U.S. Trade Representative Greer warned that trade remains a flashpoint, even with the European Union. Brazil's vice president is pushing to reduce U.S. tariffs. India and the U.S. are apparently close to a deal on reciprocal tariffs.
So the whole environment is just profoundly transactional and bilateral now.
That's the key. It's dominated by these one-off agreements, not broad, stable structures.
Moving from trade to energy, crude oil had a really reactive start to the week.
It did. It dipped initially, but then staged a firm comeback. It's just a reminder of how quickly that geopolitical risk premium can reassert itself.
So what caused the initial dip?
Crude was first weighed down by the resumption of oil loading at Russia's Novorossiysk port after those infrastructure attacks. So West Texas Intermediate and Brent both slipped a bit when supply pressure seemed to ease.
But that downside didn't last long at all. What drove the reversal?
The whole tone shifted after fresh geopolitical reports hit the wire. Specifically, Israeli warplanes targeting areas in southern Lebanon.
Okay.
That headline immediately coincided with a sharper round of buying. So even though Russia insists it has recommenced all export activity, the sequence of strikes just reminds traders that Russian oil logistics are still a huge geopolitical pressure point.
So oil is reacting to direct conflict. What about gold? It's usually the crisis hedge, but it seems kind of range-bound.
Yeah, gold is consolidating. Right now, it's behaving less like an immediate crisis hedge, that quick panic button, and more like what we call a high-duration asset.
Okay, let's unpack that term quickly. High-duration asset. What does that mean for gold right now?
So think of it this way. Gold, because it yields nothing, it becomes more attractive when future real interest rates or rate expectations are low.
Right.
And because the market is suddenly pricing out some of those Federal Reserve rate cuts we talked about earlier, gold's future value is being discounted more heavily.
So it's more sensitive to those shifting policy odds than the latest conflict headline.
Exactly. It's waiting for fresh U.S. data to break out of its range.
And speaking of precious metals, there was some long-term policy shaping coming out of Indonesia.
Indeed. Indonesia is finalizing a plan to impose export taxes of 7.5 to 15% on gold product shipments starting in 2026.
That sounds significant.
It's incredibly significant because it's part of this broader global trend among resource-rich emerging markets, what we call resource nationalism.
They want to capture more of the value chain domestically.
Precisely. Rather than just exporting raw ore, it's a long-term structural shift that increases costs for global miners and potentially shifts power over the next decade.
And finally, let's quickly touch on how equities are digesting all this. Is the S&P 500 holding up?
The tone is best described as cautious but selective. European bourses slipped a bit. U.S. equity futures are mixed.
Mixed how?
Well, you're seeing S&P 500 and NASDAQ futures slightly higher, mostly supported by mega-cap earnings and tech sentiment, but small-cap futures are underperforming quite a bit.
Which is the classic sign that macro uncertainty is weighing on the broader economy.
It is, and that tech strength seems to be driving divergence in Asia, too. South Korea's KOSPI was the clear outperformer.
Why was that?
It was helped by strong gains in chip names after reports that Samsung is raising server memory chip prices because of shortages. And that's a sharp contrast to Japan's Nikkei 225, which saw losses weighed down by both that soft GDP news and rising tensions with China.
That wraps up our discussion on the complex interplay between shifting rate cut odds, renewed trade friction, and active geopolitical flashpoints this week.
We appreciate you tuning in. Join us again soon for another essential update on the Financial Source podcast.